Welcome to the Money School podcast for January 25th, 2021. Hey, what's going on, everybody? Welcome back. Happy Monday. I hope your week is off to a great start. Markets were kind of crazy today. Opened up really strong, ended up reversing pretty sharply midday. There's a lot of big moves going on and a lot of headlines about what's happening. So I wanted to break it down. I've had some people reach out. Whenever that happens, I want to put it into a podcast. Sometimes when I'm away for a little bit, I don't want to come to you guys unless I either have a first take, a better take, or something different to say than what everybody else is saying. Sometimes we kind of get in a rut where I feel like there's a lot of voices saying the same stuff, and I feel like I don't add a lot, or I don't want to pile onto a particular topic. So kind of try to wait until things bubble up and I have something more original to share with you guys. And there's a couple things I wanted to get into. First are these big moves in the short selling that's happening with GameStop and some of the WallStreetBets stuff. And then the other stuff that I think is kind of flying under the radar is Biden's new pick to run the SEC. Just a really interesting guy, and his background and what he's interested in. I think there's potentially some pretty major changes coming for cryptocurrency and financial digital services. I'll break that down in that segment. But yeah, wanted to come to you guys with this. I don't know how much more I'm going to be releasing this week. It's just a crazy time. I own a real estate brokerage, and it's the busiest we've ever been in 12 years. So trying to keep my head above water with that. I've been a little slow on the podcast. So wanted to get back to you guys and get something else out there. I appreciate all the support for the Getting Started series that I put out and for all the Money School love. Here's episode 27. Something that you guys hear me talk about a lot is the idea of voting with your money, and how every dollar that you spend, save, invest, or gamble is all a deep reflection of yourself and what you believe and what's important to you, what your priorities are. So both voting at the poll or voting with your money, these are systems that are predicated on access. And the more access and availability to these systems, and the louder voices that more people have, the deeper the adoption and the more participation that these systems have, the more accurate, the more efficient, and the better they ultimately are overall. So this idea now of voting with your money and investing it yourself, there's a lot of really interesting, philosophical debates on, are you smart enough to manage your money? Or do you need to pay somebody to do it? Because 2/3 of the stock market is just passive money that is at some point getting charged a fee just to sit there. So the system really likes people just giving up control of their money and paying somebody to babysit it. What's happened now with free trading and Robinhood to a certain extent, but other platforms, Robinhood gets the most credit because it's the most widely adopted of all the new stock platforms. But what's happening is a deep democratization of essentially financial gerrymandering that these financial systems have had in place for their entire existence, like IPOs and SPACs now breaking that down and getting these ideas closer to the retail investor. Whereas before there were huge moats of these financial institutions protecting this system of needing to be so afraid of making a mistake, or by losing out on a return or being too dumb to do it yourself, you have to pay people to babysit your money for you and to invest it into the ideas that you already know are good, or to just gamble it themselves without any moral hazard. This long system of managed money and not having really clear access to being able, now you can open an account with your app and buy stock tomorrow if it's a trading day. If you get Robinhood Gold, they'll pull your credit, they'll front you a couple thou, and you can buy some shares. That wasn't the case 30, 40 years ago, 100 years ago. Forget it. The access to wealth and capital was reserved for a very tiny few. And now that's changing. looking at voter turnout in the last election for both parties, but the turnout was enormous. If you look at Robinhood accounts, people that are buying stocks and essentially voting with their money on ideas that they think are good or bad, that has exploded. And I think that they're connected. And I think a similar type of oppression is occurring, of learned helplessness, of where these people who hold access or who have traditionally held access, they really don't want that to change, obviously, and they don't want people to take control of their own livelihood. They just don't want it to happen. That's why you see a lot of, on CNBC all day long, they have talking heads come on, and I think some of them are fine. I really don't have an issue with most of them, honestly. I think they do a decent job at picking stocks. But you have to understand, they're never going to go on camera and say some advice that is going to make them look stupid. So their advice to you is going to always be baked in, at the end of the day, them not being wrong on a call on TV for them to then re-air in their face and be like, oh, look how wrong you were on this. So they're always going to be vague, and they're never going to really be reliable sources of what you should be doing. And I bet they would all tell you that. Like, Josh Brown would tell you that. The reliable people that actually have a good stock market, I mean, all those people are getting paid to manage money. They all work for huge companies that people don't want to manage their own money, or they have, Josh Brown is all high net worth private families that are already rich. His job is to keep them rich, not make them rich. Their objectives are different. Different people on those panels work for different companies that are all managing money. And they're, a few of thousands of people that are working for these firms that are essentially, the Edward Joneses or the Northwest Mutuals or whatever they may be, where a lot of that money is essentially at some level being invested or managed for you for a fee. And when that's the case, anything that disrupts that system is an enemy or a target. And Robinhood has been made like the Robinhood investors, and now people are starting to figure out WallStreetBets. WallStreetBets is not a new thing. This has been around for a long time. If you're not familiar with WallStreetBets, Reddit is a website that's kind of like an organized Twitter in a way. If you haven't been on it, it's hard to describe, but it's a super popular website, and it has little subcategories. One of the categories is WallStreetBets. It's memes about financials, mostly people talking shit and having fun, but it's a community that has organically grown of home investors and a lot of people that work on Wall Street that are inside big crazy options bets and stuff like that get a lot of attraction. People start to talk, but what happens is the conversation that happens on there is actually pretty decent. And what's happening is they're organizing, and their voting power is unionizing and solidifying. And it's incredible to see how that's being now turned against really particular people who are exactly on the exact opposite side of the spectrum of that. A really important concept that's playing out in the market this week is short selling. The idea of short selling, typically an investor is buying a share of stock and they're holding it over a long period of time. As those earnings grow and the demand for the stock grows, the price of the share grows, and that's how investors make their money. With short sellers, they're borrowing shares now, selling them, hoping that the stock goes down and that they can buy those shares back, pay back essentially their loan of the shares that they sold, and make a gain by the stock going down. What's happening this week, and what's happened in Tesla multiple times, because Tesla has been a company that has been bet against, this short pressure, when people are betting a lot against the stock, when they're wrong, it creates a lot of pressure to the upside. And with GameStop was one this week where it had a lot of short interest. AMC, the movie theaters, had a lot of short interest. People are betting against these companies thinking that they're going to go out of business. And then if something happens, like they get a new CEO, which happened at GameStop, now there's this crazy rush of demand to close out those short positions where they have to buy back the shares to pay back the shares that they borrowed to sell before. So when there's this spike, like what's happening in GameStop, it creates this huge supply and demand imbalance where all of these short sellers now need to buy shares to close their position. And the people that are holding the shares in these particular stocks that are being targeted, they're not very liquid stocks. There's not a ton of outstanding shares. So you're seeing this effect of coordinated through WallStreetBets and online. I think that's part of a cover, but coordinated through the internet, people are targeting the WallStreetBets thing. This is what's happening with that. They're identifying companies that have a lot of short interest, a lot of people betting against these companies, especially ones that don't have a ton of shares outstanding, and those shares are at a premium. And they're saying, okay, guys, gals, whoever, let's buy up all of the shares and all of the call options in these particular names and drive these short sellers out together. And it's creating an effect where Melvin Capital Management, a huge hedge fund who averages 30% per year, they got blown out. We're 20 days into the year. They've lost a ton of money, and then billions of dollars money just came in from Citadel and the new SAC group, which is, I mean, it's really pretty crazy that the coordinated internet WallStreetBets Robinhood trading community essentially blew out this huge hedge fund, and then they got rescued by Citadel is, you know, Griffin and the people who own the data flow for the Robinhood stuff, who get in trouble for essentially all the Robinhood traders that are, when you want to buy or sell stock, that's really critical information. So they're trafficking in the information and monetizing it. And then Point 72 and Stephen Cohen, they had to rename the company because he was disgraced. He was insider trading. So Stephen Cohen was like legendary king insider trader, like since Ivan Boesky, like probably the top guy. I don't know, there's maybe another top insider trader, but Stephen Cohen was like the guy forever. And just had huge returns. Nobody knew how. Well, he was paying for a lot of information. So this hedge fund gets blown out, and they're a trading hedge fund that has a lot of short positions, and the WallStreetBets, one by one, they've been picking these guys off, and now Ken Griffin and Stephen Cohen, through their companies, come in and inject a ton of money for a controlling stake in that company. So seems super fishy to me, like just straight up super fishy that the coordinated attack on these shorts was supposedly through WallStreetBets and these Robinhood traders, and then the people that come in to save this company are like literally the data feed selling guy that people don't like, and the insider trader guy, and they're going to come in and essentially take the other side of WallStreetBets. That's pretty crazy to me, and I think really interesting. But what's happening is terms to look up and to dive into are short selling and float and shares outstanding. If the float is small, if a company doesn't have a lot of shares outstanding that are ready to be traded, that are in the market, able to be traded, if it's really low volume, that's where these parabolic spikes can really explode higher. Or when there's a company that has, 25% of the shares outstanding are bet against, people are short, they've borrowed them and have sold them. A typical company will have like low single digits short, like net short. Like if you look at a normal S&P 500 company, like 3 to 5% short interest is pretty standard. When you're 25%, you're heavily shorted. A heavily shorted company with a low float, not a lot of shares, not trading a whole lot, if there's a coordinated effort to buy up those shares and to not have any selling demand, then you can create these artificial pockets where you have to be really careful. Like if you own GameStop right now, you have to be really careful because this is an artificial bubble that's driven by supply and demand that won't always, it never plays out well. If you look at how these parabolic moves work, they always get overheated, and then whoever is the greatest fool at the end who's still holding them ends up losing a ton of money. just be careful if you own them, and know that GameStop didn't go from, $20 to $120 because of any fundamentals. It didn't go to be a $9 billion company because of this new CEO. It's the market breaking down. And Jim Cramer this morning said that the stock market's not functioning correctly. Like there's something mechanically broken. And I fundamentally disagree. I think that the market is actually working more efficient than people think. And I think that the home gamers, through, consolidated being at home and being on the internet, but also talking to each other through the internet, are a lot bigger than people think. And WallStreetBets, in terms of just groupthink and, the herd mentality of like, we're all going to move together and essentially unionize our voice, it's never been able to happen before, which is really pretty incredible. So here's what I think is going to happen with the whole WallStreetBets and GameStop situation. Merlin Capital is a hedge fund that's run by a guy that used to work for Steve Cohen. Steve Cohen is the guy that I talked about in the last segment. He owns a company called Point 72. Point 72 used to essentially be SAC Capital. Before Steve Cohen got thrown out for insider trading, he's disbarred from the stock market for a bunch of years. He's back, owns some Mets. He's rich. Nobody gives a shit. If you have a lot of money, people really don't care. Welcome to life. It just is what it is. I don't think he's a good person or a good person for the stock market or to be able to be in a privileged position, but whatever. Neither here nor there. But Point 72 is a company that SAC has morphed into. When it was still SAC, one of his top guys now runs Merlin Capital. So it's his boy. He knows him. And then the other side, Ken Griffin, owns Citadel. He's one of the richest guys in the world. Citadel gets the data flow. They essentially are making the market for all Robinhood traders. He's making a ton of money off of Robinhood traders, accepting not perfect fills for some of their trades and shit like that. So he's the data selling guy, and the insider trading guy have now teamed up and put $2.75 billion into their hedge fund, their boy that they know. They're going to just filter information to get back at these WallStreetBets people. And that's a pretty big allegation, but those two guys are not losers in anything, period. They will cheat, rob, do whatever they have to, but they do not lose for long. So these WallStreetBets people really need to be careful, because these people have a ton of resources and they have a ton of data that's inside information that could potentially be misused. And these aren't people that have a great track record of not misusing shit that can make them rich. So if I had to guess, I would guess that these two dudes will drive a retaliation of sorts into a lot of the anti-short selling market making. A lot of the short selling is a byproduct of hedge funds just wanting to be on both sides, wanting to offset their risk by being negative and positive at the same time, and just charging to essentially, if you want to buy, if you're in Robinhood and you're buying a bunch of calls, Ken Griffin and Citadel essentially selling you those calls through the market making. It's oversimplified, but that's kind of how it works. So if you're willing to accept a worse price, they get rich. That's why Ken Griffin's rich. One of the reasons why he's super rich. Why he buys $20 million, $100 million properties like they're nothing. So if you want to be on the other side of that, be my guest. But I think that there is a reckoning coming for a lot of these. These people don't lose, like I said, for long. And if you're in these positions, especially GameStop, which is a Merlin, they have a heavy put position, and you look at WallStreetBets, they're talking shit about this guy. It's a zero-sum game. The energy just gets transferred. So for every winner, there's a loser. So if all these people getting rich owning GameStop, somebody's losing a ton of money to get those people rich. And the size of the market is far bigger than people anticipate. So a company like that having a huge move, that we're talking hundreds of millions, if not billions of dollars. And this is now spreading to all of these different illiquid type companies. And that tells me that there is a machine learning effect that's happening that's bigger than just the WallStreetBets, Robinhood traders. I think there's something bigger going on where other hedge funds are systematically finding inefficiencies in the system and rooting them out by exploiting these flaws of either incorrect short positions or just inefficiencies in the market. The reason why I feel like there's a deep learning AI machine trading type of situation happening here is it's almost too complex or efficient for just traders on the internet. And maybe I'm wrong, and maybe that en masse is more sophisticated than I had anticipated, which is probably true. I think it's more sophisticated than what Wall Street thinks it is, for sure. But to this point where it's finding these, even in big companies like Viacom had it happen today, down to really tiny little companies, something is sorting through a shitload of data and finding these inefficiencies. Whether that's the human intelligence of all of human traders using their communication through the internet to find them, or if there's a program or algorithm that's finding them, or if it's a combination of both, which it probably is. So I think that that's really fascinating. I wouldn't want to be on the other side of Ken Griffin and Stephen Cohn on anything. Like, just period. They're not people that I trust not to lose. So just be careful if you're in those positions and know that that's what's happening. Shifting gears just a bit, there's two more things that I wanted to talk about tonight. First, we're getting into earnings season, and it's really important for this particular earnings season how companies report and ultimately give guidance. So if you're new to earnings season, companies have to report their earnings every 3 months. They announce the day that they're going to report, and they report either before or after the bell when the market's closed, which honestly, I think they should do it at noon, but it's whatever. Most companies report, the stock market closes at 4 Eastern time, and they're going to report like 4:30. It's normally like a half hour after. If it's betting, the earnings estimate is like the point spread. And if you beat it, then your stock goes up. And if you don't, your stock goes down. And there's two parts to an earnings call that are really important. And that's the amount of money that they made this quarter, and then what their guidance is for next quarter or next year. And what's happening right now is the previous COVID bailout basically gave every company a pass and said, like, we're going to punt and reevaluate this 2, 3, 4 quarters down the road. That's why the stock market started to recover so fast last April, May, June. That priced in things being good now. So if things aren't good now or great, and companies can't turn around and say, yeah, things are better than we expected, and they're going to continue to be better than we expected. If they're not confident in that messaging, their stocks are getting crushed. And all of the big companies have their earnings coming up over this next little bit. And it's just really important to know, what you own, when your earnings are. A lot of money managers, the way that they do it is they have their core positions, and as they run up, they'll trim a little bit into earnings. And if the earnings are bad or the stock goes down, they add a little bit. And if it goes up, then they just rebalance. I think that's a great way to do it. I think you can hold your stocks through all of your earnings, unless they're something that you're just trading. That's a different situation. But if it's one of your core positions, I think it's great to hold on, but listen to the conference calls and listen to the expectations of the analysts and the questions that they're asking. Every company has a slightly different metric of what is internally important. Is it a social media company where the revenue per user is really important, the daily active users, or is it something like Tesla where it's operating efficiency and deliveries? So every company has their thing where it's like the critical factor in the call. So you should know that in all the companies that you own and what's really driving, that inside the institutional type of analysis. And it's all free. All of those earning calls are public. They have to be posted on the company's website. And you can listen to the CEO, the CFO, and then all the analyst questions. So if you're not doing that, get in the habit. There's great apps that have all of the earnings calls. Seeking Alpha, or there's one that's actually called Earnings Calls. And try to listen to all of the companies you own. Listen to their CEO talk every 3 months. If you can't do that, you should probably just be in an index fund. And that kind of plays into a question I get a lot of, how do I choose how many positions I want? And sometimes I'll have 5 positions, sometimes I'll have 25 positions. It's normally a reflection of how confident I am in the market broadly. And when I'm less confident, I normally contract and hold my 5 to 8 best ideas. And when I'm feeling more positive about the market, I reduce the position size and I spread it out over a bunch of different bets. So when it comes to earnings season and earnings calls and confidence, days where there's big reversals like there were today, I can feel if I am confident, if I know exactly what's going on with the companies that I own, or if I'm not as confident, or if I can tell when I'm like, shit, I don't know what's going on with this quarter. I've lost touch with this company or this story. I've kind of phased out of it, and that happens. And whenever that happens, I want to contract those positions and really stay where, like, if I can't listen to all the earnings calls and I have too many positions, if I can listen to 20 earnings calls, I'm listening to stuff all day long. So I'll put earnings calls on and listen to them while I'm working for a few hours, skip through them. A lot of people don't do that. But if you have 5 or 6 positions, you should be able to hop on and listen to Tim Cook at Apple or Jeff Bezos at Amazon talk about their company for 20 minutes. Like, you have to have that much time. If you don't, that's fine. Just buy an index fund. Part of, not to talk about Kramer over and over, but he calls it homework. I think that's a good way to look at it. Like, you're always reevaluating your position and doing your homework. And if you can't do your homework, you shouldn't be in that position. Like, if you can't, that's your rent that you have to pay to own the stock, is the time and attention to understand what's going on with the company. Follow their social media, look at their website, understand where their products are selling, reading about them on WallStreetBets, what the investor community thinks about the stuff that you own. It's important. What are a big part of what moves the stock is the demand from other participants in the market. So if big groups are tipping their hand at what their move is, I think that's important if that's a core position of yours, because a lot of these big moves are going to start hitting stocks that are seemingly innocuous. And all of a sudden they'll have a huge move out of nowhere, for better or worse. And people will either get blamed or pissed or happy depending on how it shakes out. But that stuff is going to happen. It's just going to continue to work through the market wherever there is an inefficiency. And the last thought tonight is related to all of this in another indirect way. Biden's appointee for the head of the SEC is really fascinating, an interesting, really brilliant guy. His name is Gary Gensler. And he has, for the last couple of years, been at MIT Sloan, and he really cut his teeth 2008, 9, 10 with Obama and the fallout after that, regulating a lot of the derivatives markets that helped create the last financial crisis. So he's really very experienced, deeply experienced in financial derivatives, stock market options, futures, and then also blockchain and cryptocurrency. If you look at what he's been teaching and writing while he's been at MIT for the last couple of years, has all about been blockchain, financial deregulation, machine learning, and how machine learning is potentially dangerous to financial markets. The last paper he posted was 6 weeks ago. It's in process, but it's on his website. You can literally pull it up on the MIT website. And it's a thesis paper about how deep learning and big data, AI, it's advancing so quickly that it could potentially create a threat for the entire stock market. And to have somebody that is that intelligent and masterful in some of these areas where he'll be called upon to regulate, I think is going to be a big difference than what's happened since 2016. So the chances that a company like PayPal, Square, any of these companies that are hedge funds holding Bitcoin or cryptocurrency, I think the regulations have a big potential to change. And there is just the other part of what I was talking about, that financial system that just eats on those fees. He has been one of the biggest crusaders against that whole system and has ongoing, not litigation, but disputes with these retirement and pension funds, these think tanks all across the United States that want to keep the mutual fund managed money system ecosystem in place. And he has been one of saying, hey, there is not enough transparency here and way too many fees and too much friction. And I think that is ultimately going to be good for normal investors, people that are in pension funds. I think it's going to be good for everybody to have a more stronger, clear, regulated environment for both. Bitcoin, between Treasury and the SEC and the Federal Reserve, there needs to be a coordinated effort to figure out how we're going to treat cryptocurrency. And are we going to make it essentially illegal? Are we going to make it a big pain in the ass to deal with it? Are we going to embrace it and lean into it? Are we going to do our own thing? But those are questions that need to be answered. They need to be answered fast. So I think he's a very interesting piece of that puzzle. So look up Gary Gensler, go read his paper. It's MIT level stuff. So, it can be kind of, obviously tough, but I like the fact that we're getting people that are this qualified at the appointee level. So I think that's a big upgrade. I think there's a big concern with this administration, not to end on politics, but there's a really big chance that this current administration that just got voted in, that we will see an era of big data boom. And companies like Palantir and companies like C3AI, I think will have a golden era in terms of data collection and being able to exploit that for the time being. And I think that's what's going to happen. I think the police state, I think the intelligence community, I think all of them are going to be far stronger and empowered with more resources and more of a mandate to find wrongdoing. So the IRS, the lights are back on. I think a lot of these these government agencies are going to be run again, where they've been essentially mothballed or run by people that, like, for the last 4 years, the head of the EPA has been somebody that seemingly hates the environment. I don't think that's going to be the case. But there will be special interests all over this thing. So just keep your eyes open. Outside of that, I think everything is going great. The transition has been widely received. The inauguration seemed to be really positively received by most people. It seems like we have the most consensus that we've had as a country in a bunch of years. So the vaccine crisis, the vaccine rollout has been a disaster, but I think as we lean into capitalism here and we're going to get this stuff rolling out, hopefully we can get the vaccine rolling out and we can get this health curve. It's finally starting to tip in the right direction, it seems like. But how many times have we felt that way? But I think it's really encouraging that we might have a situation here where we come out of this okay. Not unscathed, but okay. And there's really beautiful things happening with home ownership and the wealth creation, new wealth creation for a lot of new people. There's just a lot happening. COVID is just a huge opportunity to pull forward a lot of things that were already going to happen. So if you keep working through it and keep believing in things getting better, I think you're going to be rewarded. And that's what my plan is, to just keep working through it, keep investing, and keep putting my money where my mouth is, investing in these companies that are going to shape the world we live in for the next decade, 2 decades, 3 decades. That's enough for now. I hope you have a great rest of your week. I'll probably check in either a late week or next weekend, but either way, love you guys. Thanks for the support. Have a good week.